this is a massive reason why we should be looking at Apple in the first place, is just because of this return on invested capital. Hey everyone, so if you're new, well, I'm glad you found my channel. What I try to do here on my channel is explain that investing in the stock market is more than just buying a company you love and that's it, and thinking it's going to go to the moon. There are a lot of people who are going to get crushed by this mentality, and I'm trying to avoid it. My strategy is to look at an investment based on its financials, just like we would if we wanted to buy an entire company and run it ourselves, like the local gym or the local bakery. It's the same idea. So just follow along to learn how to do this yourself. Plus we will have a target buy price by the end of this video. Look, it's part art and part science anyway, so the more practice we do, the better we're going to get. And if you do actually get any value out of this video, make sure to hit that like button for me so I can get some feedback. In today's company, we're taking a look at Apple, which we obviously are very familiar with. It's one of the biggest companies in the world. I'm going to do my 9-point checklist and then I'll give you my opinion at the end. Now, I have quite an interesting relationship with Apple. See, back when I first started investing nearly 10 years ago now, Apple was actually the first company I invested in, and I had a lot of my money tied up in Apple stock. I was very sure it was undervalued. I was very confident with the projections in the future of Apple as a company. And after about, I don't know, maybe 2 years, it had more than doubled and I sold out because I was starting a new company. And this company needed capital and all the capital I had was tied up in stock. So I sold everything, put the money into the company. The company did really well and I ended up selling that company and making quite good money from it. But if I had just held my Apple stock, the same amount of Apple stock that I had, and I just held onto it, I actually worked out that I would have the same amount of money as if I didn't even start the company at all. So all of that massive amount of risk and all of that effort that I was putting into this company and growing it for 4 or 5 years, I could have done nothing and sat back and got the same result. So I guess that sort of taught me a lesson that the stock market, investing in stocks, is just like investing in a business, and it can be a lot better because the companies can be better than any business that I'm going to create. So that's my story with Apple. Look, it's a $2.5 trillion company now, but they're still bringing out new products. So the AirPods obviously was a huge money spinner for them. And the brand, Apple. Everyone knows Apple. It's one of the strongest brands in the world. I'm here in Ukraine and it's very important. It's like a status symbol to have an Apple phone. I have a Huawei phone and that's looked down upon, where an Apple phone is like, everyone's expected to have an Apple phone. I don't care for that, but it is one of the most powerful brands in the world, and I can see that even here in Ukraine. Okay, let's go through the financials now. So we're going to look at revenue growth first. And well, as we can see, it has been growing from about 100 billion back in 2011 to nearly 350 billion today. So it's more than tripled in that last 10 years. So yeah, very strong growth there for Apple. Now we turn to gross margins, and gross margins have also been very stable around that 40% mark nearly the entire decade. So that's great. I'm happy to give that a tick. It isn't declining, and that's what we're looking for here. We want to make sure it's not declining. The next thing we're going to look at is the return on invested capital. And a number above 10% is really strong, so double digit here. It's the ability of the business to reinvest money back into the company to make more money. So it's like a reinvestment rate, if that makes sense. So look, unbelievable return on invested capital here for Apple. Like, this is some of the best return on invested capital numbers and the most consistently strong that I have seen nearly ever. It's 26, 40%. The lowest it got was 19.86. The highest is right at the moment at 46%. This is incredible. This is a massive reason why we should be looking at Apple in the first place, is just because of this return on invested capital. Okay, now we turn over to debt, and I'm wanting to look for the current assets to be greater than the current liabilities. It means they're not going to have any short-term issues with their debt. So the current assets are 143 billion. Their current liabilities is 105 billion. Current assets are definitely higher than current liabilities. That's fine with me. Happy to give that a tick. Now let's turn over to free cash flow. Free cash flow is really important. That's sort of what us as owners of the business would be receiving. Now, the management team are going to do something else with that money. They might pay it as dividend, do share buybacks. Apple have been doing both of these. So the free cash flow number, if this is getting bigger, it means they can do this more aggressively. So look, from 2011, we've got 30 billion. It's now 94 billion. Wow, that's in line with the revenue growth of more than tripling. The free cash flow is more than tripled as well. That's fantastic. Yeah, fantastic growth. They're going to do a lot more, probably dividends or share buybacks or something. They're building up this massive amount of cash here. So yeah, good, very positive news here. Now, for those of you who are new to my channel, I use Interactive Brokers and Saxo Bank as my brokerage accounts. There's links in the description. I want access to international markets because a lot of the companies that I look at are not in America. So things like Robinhood and Webull and those apps aren't going to work. I also want a good, stable, long history of these brokerage accounts working. I don't want to invest in a startup like Robinhood. I want something a lot more stable. So I use these companies. So if you're interested in getting a brokerage account, if you're just starting out, I highly recommend Interactive Brokers in particular. Okay, now looking at shares outstanding. Now, if this number is getting bigger, it means we're getting diluted, and that's a problem. If this number is stable, it's fine. If it's declining, it's even better. It means our ownership in the company is getting stronger. So if we look at the shares outstanding, wow, it has been declining very, very rapidly here from 26 billion down to, I think it's under 17 billion at the moment. That's a lot of share buybacks they've been doing over the last decade. So wow, another very strong tick here for Apple. Next up is insider ownership, and I want the incentives of the management team to align with us as shareholders. So we want to look for how much ownership Timothy Cook has, who's the CEO. He has about $500 million in Apple stock, and his compensation is about 14 million. So he's getting paid 14 million a year, but he has $500 million in stock. The stock price is obviously far more important to his net wealth than his salary. So look, that's all we need. We just want that alignment of incentives. So that's great. The second last thing we look at is whether any super investors are invested in the company. See, I'm an idiot. I'm not very good at this, and I'm really trying to see whether someone else who has decades of experience, far smarter than me, gone through many more cycles than me, if they've invested in this company, then that gives me a lot more conviction in my ideas. So to look for that, we go here, we go into Data Roma, and look, Apple is owned by a lot of people. The big ones here are obviously Warren Buffett. I think he's the biggest shareholder in Apple, and Warren Buffett's probably he will go down as the greatest investor of all time. He's one of the richest men in the world through his investments. If he loves Apple, it's actually 41% of his portfolio. Wow, okay, he has a huge stake in Apple. Another guy here that I really like is Li Lu from Himalaya Capital. I have a lot of respect for him as well. Thomas Gaynor as well. Some good names here on this list. There's a lot of conviction here from these guys, and that gives me a lot more conviction in the idea as well. Okay, so we've had pretty much a perfect sheet so far, but it's all going to come down to the price. See, even if it's an amazing company, we don't want to overpay for it. So just like a Ferrari, for example, we're not paying $20 million for a Ferrari. It's only worth $200,000. So we're not going to overpay because it's going to give us a bad return on our investment, no matter how good the company is. We want to pay at least a fair price, if not below fair price, to get a bit of a bargain. So to work this out, what I use is my intrinsic value calculator, and I've actually already put in a lot of the assumptions here already. Now the growth rates, 12 and 10% is what I've used, and that's actually pretty aggressive because if I go back and have a look at the growth rates historically, well, revenue has, for the last 10 years, it's been growing at 15%, operating income is 13%, net income is 15%, earnings per share is nearly 20%, but more recent times, it's growing only sort of single-digit growth of the last year or two. So it has been slowing down. Obviously, it's getting so big now that it's hard to maintain double-digit growth. I think I'm being actually really optimistic in giving them 12 and 10% here. So my return on investment goal, now I want 30% out of my investments. That's what I'm aiming for, but it really means I'm trying to get in the 20% range because sort of a shoot for the stars and I might land on the moon kind of idea. And I just want to get market-beating returns and I need a margin of safety. So I aim for 30% as my number where I feel like a bit more confident in the idea. We'll play around with this in a moment to see whether we can work out what its fair value is, but this is more of a buy price for me. The multiple I could sell it for at these growth rates, it's a great company. 20 times free cash flow is plenty high enough. Now the free cash flow number is 95 billion, shares outstanding, total cash, total debt. Plugged all that in, it tells me I want to buy this at about $40. So the share price at the moment, I don't know, depends when you're watching this, but it's about $140. So we're not even close, but let's try to find its fair value now. So let's assume that it is going to do sort of 12, let's even bump that up to 15% for the next 5 years. And then it'll slow down after that to 10%. But let's give it, I don't know, let's say we only want to get 15% return on our money. This is not including a margin of safety. And our buy price now is about $120, $130 range. It's closer to what it is today at today's price. So in saying all that, I would say Apple is probably fair priced about now, but I like a margin of safety. I want to get stronger than market beating returns. And I think you're probably only going to match the market with an investment in today's prices. I would love to see this cut in half pretty much, but I'm probably not going to get that to happen. So my opinion is this: Apple has amazing return on invested capital metrics. They have amazing financials just overall. It's an innovative company. It's a very strong brand. We've got Warren Buffett, Lee Lu, Thomas Gaynor, all invested in the company. I think it's right on fair value. Look, I think we're only going to get market average returns investing at these prices. And just because that market cap is so big, that growth is going to be hard. And look, I know they can just add in new products, and that's something they've been doing, and they've been able to demonstrate this in the past. AirPods is a really good example. So maybe they bring out, I don't know, Apple glasses or the Apple car, and it keeps that growth engine going. But at $2.5 trillion, they really have to deliver on these things. So I don't know, this one's up to you guys. I can see maybe we don't need as big of a margin of safety. Maybe something under $100 is probably a bit better of a deal. But for me, I'm happy to pass on this one. I really need a better price. Now, I'm sure I'm going to get a lot of conflicting points of view here on this one. I do think it's a fantastic company, don't get me wrong. Now, if you did enjoy this analysis today, make sure you subscribe before you go so you can follow along with my channel, and I will see you in the next video.